Hello and welcome to the Quality Investor. With earnings season in full swing, I've been providing commentary on various businesses and their earnings results. This is a way for me to assess if my investment thesis remains intact, if it is an investment that I hold. A couple weeks ago, McDonald's, ticker MCD, released their earnings. Since 2013, McDonald's has seen a pretty steady decline in their earnings, with a low point coming during the summer of COVID in 2020. But they have been climbing back up since then, and they have delivered 10% plus growth in the past 2 quarters. So in my view, McDonald's is a bit on the slow growth side of things, but they do have a strong record of returning capital to shareholders through both dividends and share repurchases. In fact, they just raised their dividend by another 10%, and they are only 3 years away from becoming a dividend king. However, I do believe we are going to see some above average growth for McDonald's in the coming decade due to some initiatives that they have in their pipeline. My investment thesis for McDonald's is simple. Point 1. McDonald's is effectively a landlord owning the real estate most of the restaurants are located on and collecting rent checks along with royalty fees. This is what allows for the 50% and above gross margins. Point 2. They are investing heavily in digital ordering and AI to drive down food prep times even more. A colleague of mine who is a former McDonald's executive told me they are using AI to predict a customer's habits. For example, an individual goes to lunch every Monday for a Big Mac. Instead of having to place an order, the AI will place the order for him, and all the person must do is go to the restaurant to grab it. We'll see if they can pull that off. They are moving to push marketing and selling costs down to the franchisee level, thus saving more on SG&A overhead at the corporate level and expanding margins even further. And finally, they reward shareholders with growing dividend and share repurchases. All right, let's get into those earnings. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, hit that notification bell so you can be notified right away when I post more stock analysis content. All right, on the screen, we have here McDonald's Q3 fiscal year 2023 income statement in a visual format. Now, so we can see here, they have sales from company-owned restaurants and franchise restaurants. Now, about a little less than 2/3 of their sales are from the franchise-owned restaurants, but look at this gross margin here. 85% gross margin comes from their franchisees versus 16% gross margin from their company-owned restaurants. And that is what I mean when I say they're a landlord. So they are collecting so much rent from the franchisees, that's what leads to these really high gross margins. And once all those operating expenses and non-operating expenses are taken out, we can see they're left with a massive net profit of $2.3 billion. And this is just for Q3, and a 35% net margin. What we're looking at here is the strategic plan for McDonald's. It's called Accelerating the Arches. And what I wanted to point out quickly here is a couple of things. So first, the double down on the 4 Ds: delivery, digital, drive-through, and development. Notice there's no increasing the amount of restaurants they have. What they're doing is they're really trying to focus on the experience that current customers have in ordering. So they're going to be driving through their digital delivery system, as well as lowering the amount of time you're spending in that drive-through lane. And they're also committing to the core. So burger, chicken, and coffee. Basically, they're sticking to what made McDonald's great in the first place. And that's something I love to see out of companies. You know, when a company tries to move away from what they're very good at doing, that's when a company runs into trouble. But McDonald's is committing to what made them great in the first place, which is delivering hamburgers quickly. So I want to move on to my updated valuation model I have for McDonald's after they released their earnings. And I want to point out a few things. So you can see here in the last 10 years, they definitely had that very stagnant growth in their revenue, where they're relatively flat over the last 10 years. And that revenue stagnation has kind of bled through the rest of the income statement here. We can see free cash flow growth is only 3.4% over the last 10 years. They've only expanded their earnings per share 4.5%. And even with the share repurchases they've done, it's just not as much as we expect to see out of a company like McDonald's. However, like I said, they are definitely planning on expanding that growth in the future and expanding the margins more importantly. So you can see here they have nearly 14% year-over-year growth for Q3, and I'm projecting again 14% growth at the Q4. And ultimately, the next 10 years for revenue, I'm projecting a 7% compound annual growth rate. And finally, for free cash flow, an 11.6% compound annual growth rate. And that's predicting here a increase of margins to 36%. So if McDonald's delivers on their initiatives and they expand those margins, that would certainly flow through down to the free cash flow, and we should see that free cash flow margin increase quite a bit, which would lead to very good free cash flow gains for shareholders. But the real question, of course, is McDonald's a good buy right now? So after I discount that free cash flow back for 10 years, we get a discounted cash flow price of $241.10. The dividend, however, is very nice. And if the dividend continues to grow at that 10% pace that we've seen, that would give us a dividend discount model here of $342.63. And when we compare them to their peers, and the exit multiple valuation is $327.25. So on a trailing 12 basis, their PE ratio, it is a little bit less than their 5 and 10 year averages. So they may be on sale right now, but their forward PE is right in line with their 5 and 10 year. But their margins have certainly been increasing in the last 10 years. You can see they're well above their 10 year average for both their gross margin and their operating margin. And they're starting to deliver consistent above 15% return on invested capital. I do want to see that return on capital employed get a little bit higher, but they're starting to really deliver on their initiatives. So right now, their current share price is $266.91 as of this recording, and my valuation average is $277.11. That gives us only a potential upside right now of about 3.8%. And I like to put in a 10% margin of safety for McDonald's. They're a very predictable and consistent company, so I'm comfortable with that for myself. And that would give us an acceptable buy price of $249.40 and a weight recommendation. So despite the PE ratio being a little bit cheaper than their 10-year average here, I do think they're still a little bit high, and we can see that buy price, it certainly comes down. If you look at the last 3-year chart here, there are a lot of dips for McDonald's in which you can scoop up some shares, and I was able to pick up a little bit here when it fell below 250. However, I will be waiting again until it falls a little bit more. So before we go, I do want to emphasize that this is not financial advice, and I do own a stake in McDonald's. But what do you guys think? Let me know in the comments below. I really do love the feedback, and thank you for watching today's video. Also, please hit that like button, and if you found this info helpful, please subscribe to the channel and join our community. Thank you again, and happy investing.